Hello and welcome to another episode of Chillin' with Dylan. Today we got an absolutely cracker of a topic, and we welcome back again an awesome guest that has appeared in the podcast before, Leo. Thanks for joining us today. How are you going today?
I'm doing all right. Thanks for inviting me, Dylan. It's good to talk about something more complex than football
Yep.
and
This
the
is
Premier League.
going up in complexity, and in case you guys are wondering, we're here in the CWD studios, which is namely our flat. So good times ahead. Hopefully the sound quality is better. I've heard a lot of feedback from some of you fans. So yeah, trying our best to improve things. But the topic today, it is about the economy, which can be summed up in a very short statement that people might have thought to themselves. So, like, what's even happening with the economy these days? We've heard so much in the media, from mum and dad, from your, mates and everyone around you. And a lot of people think they're experts, but I hope that we can add our 2 cents as well to all the noise that's happening, because there's a lot of stuff happening and it's very crazy times indeed, unprecedented even. So yeah, I'm glad we got Leo along. So what have you done or studied or have experience within this great field of economics, Leo?
Well, I think of course, your listeners will know that you and I both did economics together.
Yep.
Of course, you're more of a data analyst. I'm
Yep.
more of a political economist.
Yep.
As someone that's been involved in public policy for about 2 and a bit years.
Yeah.
And of course, I am deeply fascinated by the discipline. And I read Bloomberg. I am incessantly following economists such as Larry Summers, Danny Roderick, Stiglitz, and other sort of global and you could say well-known American commentators from time to time. And of course, I've published reports on the intersection between housing and demography. I've also obviously written an entire report on walking the path to the next GFC with my former colleague, Dr. Bryce Wilkinson.
You guys should
as well.
definitely check that one out, by the way, if anyone wants to. It's a bit of extra for experts. And a bit of self, advertising and plugging, which we love doing on. Everyone should do that. But yeah, honestly, I think Leo has a lot of good things to say. I also studied economics as a major, my commerce degree at Auckland University. We didn't actually know each other at the time, unfortunately.
Well, you're an engineer, so
we hung out in different circles almost.
Right.
Yeah, I also did engineering, and so I can apply that other perspective on this kind of field. I've done a little bit of work loosely in the economic space. I used to do a bit of forecasting work of like labor markets and things like this in my government job previously when worked there. So yeah, I have a bit of work experience and a bit of study experience, and yeah, it's good to just combine our knowledge today. So
That's right.
without further ado, what's an economy, Leo? What is this? How does the economy work in a nutshell?
Well,
Summarize it. Yeah.
There are many different definitions. My hero Thomas Sowell defines it as, it's all about scarcity. When a resource is scarce. Greg Mankiw, who wrote the Stage 2 macroeconomics textbook, suggests that actually it's all about just resources. So how do you utilize capital and labor, all sorts of resources to make sure you get a return on investment or something like that. So there's a lot of intersection between finance as well. But to me, I prefer the former definition by Tom Sowell, where it's really about, are resources scarce or are they abundant? So that's what dictates whether prices go down or up. And of course, stage 1 economics students learn about the rule of supply and demand. And I think, just by knowing that broad, graph, that chart, you'll have a broad understanding in terms of why perhaps prices go up and prices go down. But there are many variants of markets, of course. But you, me, others, small businesses, big corporates, governments, central banks, insurance companies, they're all part of this ecosystem. And the more fascinating thing to me is that we're part of a global market.
Yeah, it's not interconnected.
That's right. It's not an autarkic sort of economy where we're not North Korea.
Yeah, back in the day when there was less trade and much less mobility between countries, then maybe you could have these individual markets operating in themselves. But everything's connected. What happens on the other side of the world, which is exactly, So we're in New Zealand. We're recording this. And so whoever's listening in Spain, whatever's happening there at the antipode of the country we're in, it's affecting us and we're affecting you.
Yeah, and of course, the Europeans are facing a massive energy crisis due to war in Ukraine. And so my personal favorite sub-discipline within economics is actually international political economy, because politics does a lot of good and sometimes a lot of bad in terms of economic determinants.
And at the end of the day, these are often driven by the politicians that have either been voted in or not voted in, or the leaders of the countries and such. Some of these leaders of the country might not be politicians. It could be central bank leaders and governors. So I've heard they often play a big role in how an economy works. And I hope people have heard a little bit about things like the Reserve Bank in New Zealand, the Reserve Bank, but say in other countries, say the US, you have the Fed and the European Bank over there.
Yeah, the European Central Bank,
Yeah, so what do you think they do in this whole thing?
Well, the thing is, I'll just introduce a new topic in relation to this, and of course, there are many variants of ideologies in economics as well.
Yeah,
now,
of course.
Because people think, this is the thing, right? People think that economics is just like maths or physics or biology.
Yeah.
That you can just simply have like a data analytical skill set, and if you know how to do some stuff with statistics, you can automatically be an economist. But reality is, there's always an ideology applied to it.
Well, that's why it's often in the arts programs of many universities and colleges. You can argue both ways, even though it's quantitative.
That's
right. You can be like, it's just people writing their opinion and putting numbers behind it, and because everyone's too don't have enough time or can't understand it, they're just like, wow, that's so smart. This is fact. I'll take this particular economist's libertarian or whatever
Marxist
view,
or Austrian.
whatever view as a fact, as truth, and that doesn't necessarily have to be the case. When we've studied economics, we see it through different lens. There's behavioral economics, for example. There's the more empirical versions, and you can actually it's cool because you can use what you know and critique or agree with everyone. So just think of your average Joe media commentator putting some stats on on the news, on an article. That's, you don't just believe all that right away, right?
No, you don't.
It's just someone's opinion, and it might not completely cover everything.
No, but data does matter still.
It does. You want to put good stuff out there.
And to chime it in, so, I talked a little bit, I was going to talk about Austrian economics, I was going to talk about Keynesian, but, and back to the topic of central banking, central banks actually, did not exist prior.
Yeah.
We used to have a system called free banking.
Yeah.
Where basically private, you could say, think of you starting a company and saying you're a bank.
Yeah.
And you have this sort of coin, that sort of coin. Yeah. You have this sort of weird metal version.
That sounds like Bitcoin, but in real life.
Yeah. But there was no crypto central authority that said, hey, here's the New Zealand dollar and this is legal tender.
Yeah.
They tried salt. They tried, you go say,
I've heard a podcast about seashells, though.
Yeah, seashells.
Used in certain economies in certain ages, which is pretty...
During the Second World War, people were using cigarettes.
Yeah.
So it's all about how you use commodities as a way of exchanging goods or exchanging, it's a medium of exchange, a form of trading value, basically. But central banks actually sort of became gradually more, you could say, powerful
Yeah.
as a result of political factors.
Yeah.
And of course, politicians who have control of the access or the supply of money are going to be extremely powerful, right?
Yeah, yeah.
That's the reason why we have now, of course, central banks today have a lot of more credibility.
Yeah.
They have to be transparent. They release statements openly in terms of what they're going to do, whether they're going to print more money or if they're going to hike up interest rates to curb inflation.
And in contemporary economics, it's
Yep.
very important for the central bank to be independent.
Yes.
One of the key tenets of this whole thing.
Absolutely.
I think this is what a lot of people don't get, and that's okay if you don't, but central banks and governments are completely separate in theory. Like they should have the economy as a whole in mind, not the agenda or like what benefits a political party or not. That's how it should be.
Yep, correct.
And they have autonomy most of the time. Yeah.
But
and then,
people don't
yeah.
know much about central banks. It's actually a little bit of a tragedy in my view. Like,
Yeah.
you know, if you just read, for example, in New Zealand, the Reserve Bank of New Zealand is like, you know, you could say papers that they release publicly. They make it very clear around July 2021 that they will be increasing interest rates. Now, the normal Joe will go, what the hell does that mean?
Yeah.
Well, it just means that you going out and going to a bank or going out to a non-banking entity to try and borrow capital or get a mortgage will be very, very more expensive, where you're going to pay, thousands more dollars to pay off interest.
Yeah, and that affects a lot of people.
Affects everybody.
And the amount that actually affects everyone versus how much people know is actually quite disengaged. Like if it affects all your household expenses, like say if you have a mortgage, you theoretically should just know a lot about this because it changes a lot about people's lives on the whole and individually as well. So central banks are important, governments are as well. You've touched on that. Sometimes governments can play a big role in building economy. I think, for example, you always go on about Singapore, and what they've done over decades of building like a nation like that. That started from not much. Let's say your startup, but with like a country instead, and they're like quite successful in a lot of economic terms these days.
You could call it individual brilliance. I think my hero, Charlie Munger from Berkshire Hathaway, kind of famously described the founding father of Singapore, Lee Kuan Yew, as the Warren Buffett of Singapore. Like kind of used that connotation of saying he's like the guy that kind of like made a very very extremely successful investing company.
Mm-hmm. Yeah.
Sort of comparing that to developing an entire nation from bottom up. But just to tie in with your points regarding the interconnections between government and central banks, like the reason why government matters, like for example in New Zealand, is that the Reserve Bank is actually owned by the New Zealand government. Yeah. Except they have the independent mandate, so the government can't go in and tell them you got to do this. Yeah. Like for example, in the United States, the Federal Reserve is actually private. Yeah. So each of the 12, Federal Reserve of Dallas, Federal Reserve of New York, all independently coordinate, but they have their own shareholders and that kind of thing. Yeah. So it's a bit different, except the appointments to the Federal Reserve is indeed by Congress. And so it's kind of like semi-public, semi-private.
Yeah, it's much more complicated in the US, just like everything, just like politics and things like that in general. Yep. So, but actually the US is very important in terms of understanding, because everything they do is, like, as we say, like what happens on one side of the world is influenced by another. Literally everything about especially their currency, US dollar.
It's the reserve currency of the world.
Everything's tied to it.
Yep.
Like, it has major impacts on exports, imports, and just a lot of things. That's why we talk about it a lot, I guess. Although, places like the Euro in Asia, they're becoming a bigger role, especially in Asia, having a bigger role in financial markets over the years. But there's a lot of things going on in an economy. So like, I guess this is just a thing that like, to say that when someone says, this decision by this company or this political party will do this. It might be true, but there might be 2 or 3 other factors that might also be true, balancing each other out. So, this thing does not necessarily mean house prices will go up because of it or not. It's probably all, a lot of things happening at the same time. But yeah, so like that's a bit about how, the complexity of the economies of the world works. One of the trends or things that's been talked about a lot and noticed a lot these days is inflation. Question a lot of people's minds is, why is everything going up in price? Is it just, related to the government, or is it banks? Are they just trying to make everyone run out of money? What's happening?
I think my view is in line with what Milton Friedman famously said during the 1970s. He said, quote, "Inflation is always and everywhere a monetary phenomenon."
Mm-hmm.
So for example, the reason why your groceries, the reason why you could say just broad consumer goods have all gone up is because, in my view, basically the aggressive intervention of the Reserve Bank, the aggressive intervention of the Federal Reserve, and also the European Central Bank.
Yeah.
They basically, it's called quantitative easing if you use technical terms.
Yeah.
It's actually more of money printing. So it's not print.
They're not physically printing money.
They're digitally printing, but they are using that money that they sort of brought into the world to buy government bonds.
Yeah.
And another thing is, just to mention to the listeners, is that governments borrow money.
Yeah.
They first tax you to get some form of revenue for the government to run their businesses, pay politicians,
public servants,
run the machine of government, pass the, all that stuff is paid off, and, your health and superannuation.
Education in most cases.
All of that is paid for by tax revenue, but there's a bit of it where you need to borrow from investors. And actually the central bank, sometimes as lender of last resort, when they think that the economy is going so bad, can use those programs. So they print it and they buy it. Just to give some facts out, the Reserve Bank actually had a $9 billion loss as a result of that program.
Yeah.
So what they did was the money that they printed to buy government bonds was actually $9 billion more expensive than it is now. And that's due to their own policies.
Yeah.
Now the Reserve Bank, since July, decided to increase its interest rates. Now I know this is all complex for the vast majority, and it is. When I started learning about this, I thought, wait, monetary policy, fiscal policy, government, what? But the core thing is that every decision that Adrian or what the government does really matters. And to tie back to your question in inflation, it is a monetary phenomenon, but the reason why is because if the government spends far too much money, right, they need to pay far more, you could say, interest on their debt obligations. Yeah. And at the same time, that will hike up demand. So supply and demand thing that I talked about, it's really, really putting a lot of demand into the economy.
Yeah.
And at the same time, not only did they, print a lot of money, they lowered their rates to zero. Yeah. What happens if you're basically giving money out for free? That's basically it.
So, essentially, not just, people can't borrow at zero, but like organizations
or banks, commercial banks.
They can just get free money.
Yeah.
And if they can make a profit on it, then they will lend it out at a higher interest rate for themselves. And so basically, if you think about, let's go analogy again. Yeah. We love this stuff. It's like a balloon, right? Like, it's a massive,
bubble.
Like a bubble, balloon, whatever. The lower the interest rates, the more government does sort of policies that stimulates demand. There's a lot of stuff going out. And so, it's like a balloon that's getting bigger. But it can also come down and contract. One of the cool concepts is the sort of quantity and velocity and supply of money, that equation in economics. So the more there is floating around, then the more people have to use on the same. If it's the same amount of stuff, physical goods or whatever, then
But more money. Then
then more people are going to be fighting with the same number of things with more money. So, for example, is like if like although everyone pretty much did it, so not naming names or shaming every government. When COVID came, obviously once in a lifetime sort of generation
actually.
event. Yeah.
Global pandemic.
No one knows what to do. So, you're like, okay, like probably best to give money. And that's good. Give it to businesses, individuals. But then the problem is that they haven't been making more stuff. They have been sitting at home. They've, less things have actually been produced. So if you think about that imbalance, less stuff, more money, it's like inflation.
Yeah.
But it doesn't happen right away. And we see it now.
It took a bit of time. But the current trend, actually, there have been a number of experts that have called this.
Mm-hmm.
There were a few that said, there's a team of economists that was mockingly coined team transitory.
Yeah.
That this is going to be transitory inflation. It's going to peak at about 4%, 3%. Everything will be going back to normal. But when you look at the amount, as in think of it like a bath water, right? Bathtub, right?
Yeah.
The idea is that you look at the nominal GDP. Okay, the amount. Oh crap! This is gonna overflow, and this will automatically lead to far higher prices due to the quantity of money going up to that substantial degree. Yeah. And also think about this, right? Is COVID-19 led to closed borders?
Yeah.
People think this is a demand problem. It's not. It's a supply problem.
Yeah.
So by forcefully closing borders, you basically stop economic activity, and then after you open the economy again, and you printed all that money, boy, you're gonna have labor shortages. There's gonna be inadequate supply to meet the demand in terms of the loanable funds market to provide credit.
Yeah. Like
it's all bottlenecks. It's all bottlenecks that's embedded in the economy globally.
Yeah, and it's almost closing the borders is kind of at an economic level quite inefficient. Like this is like it stops the flow of labor, capital, and just like general connections. Like businesses often need to meet face to face to actually make deals and sign contracts and things like that. And so do governments. But yeah, that whole period, which is not necessarily anyone's fault. It's just obviously the virus, the health implications were far greater.
Well, some people like, for example, Victoria University of Wellington professor Arthur Grimes said that this money printing program, LSAP, was not needed.
Yeah.
That they could have just lowered their rates as they did in 2008 and let fiscal policy deal with it. And another thing that actually contributed to this, Dylan, is actually war.
Oh yeah, I was gonna touch on that. War is unpredictable,
that's right.
and it is
actually
very influential.
If anyone, I'm mentioning a lot of names in this podcast, but Stanford University Hoover Fellow Neil Ferguson's done a lot of work connecting economic outcomes with conflict, war, and you could say tensions between countries. And he's found that actually, whenever there's even civil war, there are times when actually inflation spikes up.
Yeah.
Because governments, what do they need to do? They need money.
Yeah.
And to get that money, what are they going to ask their central banks to do? Print more money.
Yeah, but the money doesn't actually change what's on the ground, the physical conditions.
No, it doesn't.
If war's going on, that's most of the time very, very unproductive activity.
No, it is. But
very with more money that obviously goes into what
you got to pay your soldiers, right?
Yeah,
you got to pay your soldiers, and that's why Russia. It's not only Russia, but also obviously the Americans have been putting a lot of financing for Ukraine, and there's a lot of connections between economics, politics, and even conflict studies.
Yeah, no, there is.
And I know for a fact that the vast majority of economists that I admire and also respect, but a lot of them tend to forget the role of war a lot. They think like technocrats or quantitative economists that use data or R programs to say, here's a modeling example, and that's what I believe will turn out to be the case. But as we know, John Maynard Keynes said, the world is always uncertain.
Yeah.
And, and I say this out to the public and people who might listen, it's just we have to contemplate when things completely go out of hand, right?
Yeah.
Like for example, like let's just use another metaphor.
Yeah,
right?
let's go.
Like, let's say you are living in a normal family. You're a high school kid. You have you have mom and dad, right, in the house, and maybe like a sister, right? You're like a four-person household. And if we just think we're gonna live till we're like 100 or whatever, or things won't go to whack, but maybe the sister might trip over concrete and break her leg, and then boom, medical costs, or the dad might make a impulsive mistake, and then boom, there goes the house. Like it's just it's because human beings are not like robots. We're not Homo economicus. We're Homo sapiens. And economists, in my view, have really forgotten that element of human agency, human nature. And that's why they, this, Dylan. They forgot. They missed the GFC of 2008 completely.
And good chance more will be missed. Like history tends to repeat itself. Like
history is a better indicator.
History is
bloody models.
History is pretty great. If you can interpret it and if you have time for it. And we should probably hear more about it. Maybe even specifically in future podcasts. But no, so lots going on, and I think in the last couple of years the world has seen COVID, lockdowns, border closures, and war, in very key areas more than before. And I guess one of the other things that's happening always gets talked about. Why are there shortages in everything? Everyone's asking that. The media is trying to, we're trying to figure out where these things are, but often most everyday people, we're not going to see it with our eyes where that's all coming from. So what do you think? There's a lot of things, right? In terms of labor, totally can see many businesses and organizations struggling to get staff, particularly talented, skilled staff, labor.
And building staff. And
things like that. Specific things, because people don't just pop out of nowhere. I don't know, maybe in a future world, probably not, but people come from somewhere, like someone who's going to be working, they usually need to live for probably 18 years or whatever it is, or 20 something years to be productive. That takes time.
I think regarding the shortage of labor and staff and materials, it's in line with what I said before. We have artificially closed our borders, so we in the short term shut our supply chain, shut our borders, stop things from coming in, and so then we try to open up, so you have a massive inflow of supply of like a lot of bottlenecks to the economy, right? And then you see brain drain problems. We've seen a lot of our friends that are moving over to Australia or the UK.
That's probably my fault half of the time for making those podcasts about New Zealand and Australia. Whoops. Sorry, guys.
But at the same time, in the demand side, I don't think we would be in as bad of a mess if we got our monetary policy settings right, if we got our fiscal policy right. I think if it was more targeted, then I don't think we would see this level of discontent among people that own businesses or need staffers or need capital. And government policy as well, right? Like, for example, I've been mindful of, for instance, to have a successful economy, you need to make sure that demand and supply actually meet. We have a shortage of supply and pent up demand. So now, right, the Reserve Bank is actually trying to shut down the economy by raking up interest rates.
And there's like some sort of elasticity or something going on, isn't
it?
Which is a
demand.
Concept that some of you probably won't have heard too much about, but
I think you meant supply, not demand, because
it's like you raising rates can only go so far, sort of thing.
Correct.
That's the gist of it. It's a hard word. You can do it so far, and it affects certain parts of the economy. But other things, yeah, it can also move on its own. And a lot of these things are going at such high momentum. So, yeah, we'll have to see how much interest rates will continue to go up. What have you heard on this, Leo? Like, do you think, I've heard, end of this year, maybe some of next year?
There
Do you
are
think it
people.
will continue and continue? Do you think that's going to be the case?
Look, I think it's inevitable that central banks need to continue to hike up rates.
Yeah.
But also the forgotten element that I forgot to say in this podcast is that actually debt level matters to some degree.
Yeah.
Because government debt obligations depend on central bank interest rates.
Yeah.
What's going on in Europe, actually? I wanted to talk about the Eurozone.
Yeah, it's Europe is always fun. Yeah, in all sorts of ways.
Well, it's not fun. Well,
to travel to.
Travel to it's good, but in terms of their macroeconomic setting, it's absolutely hopeless. And I'm not saying this
Sorry
to
to all
deride.
the Europeans out there. We do have some European listeners.
Well, it's not. I'm not talking about the people. I'm talking about their institutional.
Yeah.
The way that the European Central Bank is set up.
It's really difficult and complex.
Yeah.
In how it works, but
because I'll tell you the European Central Bank has a huge political dilemma.
Yeah.
The reason is you have Greece, which has a debt level of beyond 200%.
Yeah.
You have
that means what you mean then is that
what happens
how much the country owes, the government owes, is literally 2 times how much they earn in a year.
Yeah. So the annual amount that they produce, they have twice as much of debt than how much they produce annually.
Imagine how much you earn in 1 year and then double that.
This is an experiment that's ongoing. But on a macro level, the Greeks are just chugging along because the European Central Bank are like, well, it's okay. And you have the Spanish that are at about 180. You have the the Southern Europeans, the other ones, the Italians that are even worse. It's just, and then you have the
hectic.
Yeah, you have the Greeks that are at about not the Greeks, the Germans that are about 70%.
That's pretty high for the Germans. Yeah,
it's pretty high because they've been continuing to bail out the Greeks.
Yeah.
And this is the problem with having a consolidated, monetary union, because your fiscal settings and your economic settings are different, your productivity levels are different, your demography is all different, and yet they're supposed to have very similar yield rates. Now, yield rates is basically the interest costs are based on that particular bond. I know this sounds very, very technical, but just to get to the point is that if the European Central Bank continues to rake its rates, they could bankrupt Greece or Spain or Italy and turn the Eurozone completely and utterly upside down, where you see a meltdown of assets, where governments can't pay their debts back, and unemployment spikes to 30 or 40%.
That's really worrying for Europe, particularly in the southern European countries.
Greeks, sovereign debt crisis in 2011, the Euro crisis led to their unemployment rate going to 25%.
Yeah,
youth unemployment is still 80%.
I think it's pretty crazy because since the GFC, some of those European countries still haven't fully recovered, and then this is going to be a big hit. And I actually, it's a bit worrying. It's the younger people, those in the age groups or generations around the millennials and things.
They'll go to London,
and But, a lot of the younger people, like people in their 20s and 30s, those that never got to get a foothold in any part of the economy properly, like whether it's a job or a house, or even to start a family, like often that stuff has, like, the economy also has a big impact on population and demographic factors, which we see a lot of countries, developed countries, that struggling to increase their population by natural means. And in New Zealand, I think, over the recent years, the immigration has kind of been the thing that's been building the population up slowly. With that gone in the last 2 years or so, like that kind of started. That's like a opposite trend. Whereas other countries don't really take many immigrants, especially places like Japan, Korea. A lot of the other developed, highly developed Asian countries. And yeah, that is a massive trend. I think people probably forget this a lot, but that will have big impacts in future years. You got, like, in countries like New Zealand, baby boomers, this generation, like heading towards retirement, and that's like massive amount of people who will be retiring, first of all, but then also not working. That should theoretically mean more work opportunities for the younger ones. I don't know. But yeah, there's stuff like that going on. I guess last couple of years it's been interesting. I like to use the term the COVIDed economy. Like, a lot of things have happened since then. So is there any similarities or differences to when 10 or so years ago or more we had the GFC and the other stuff? Like, any things that people got wrong or right?
Well, the difference is that the COVID economy post 2020 was really caused purposefully by governments.
Yeah.
Lockdowns, closed borders. When you look at that, I mean, it's unprecedented. Never in macroeconomic history have governments decided to actually purposely shut down business activity. That's the first thing. The GFC of 2008 was actually caused by, a banking crisis.
Yeah.
It was caused internally, where banks, through, buying, complex financial instruments and products such as, collateralated debt obligations or
CDOs,
synthetic collateralated debt obligations or credit default swaps or all these, these are trillions of dollars worth of things, but, you can't really mathematically calculate these instruments properly, but I think a lot of the financial institutions made a gamble in this, and this bubble through the housing market in the United States turned the world economy upside down. So the difference is COVID was caused by enforced government action. The other was caused actually by the mistakes and fraudulent behavior by some of the people in these institutions. But at the same time, the policy responses were very similar.
No one did anything that bucked the trend. Like, with COVID responses, we saw at least Sweden and a few others. They were like, we weren't completely closed. There were a few maybe arguable economic benefits for them, but reserve bank, central banks and governments all expanded spending and lowered interest rates. No one tried, because it's like, if everyone else is doing it, then like, surely it'll work. That's the sort of thinking that must have been going on. And it's like, you react to this unexpected event of COVID, and if everyone's doing this thing, surely that's the thing to do. I must imagine that's the thinking.
Well, it's kind of like, for example, if you have a cold, you're going to take antibiotics probably, right? But if you had a heart attack, but if you're like, oh my God, I need to eat something I don't know what's happening, maybe you might try antibiotics. It's something similar. Something similar has been happening during that course. Like 10 years ago, the same fiscal and monetary policy. And William White, he's the former BIS chief economist. He defined it as ultra easy monetary policy. So we've done ultra easy monetary policy twice in a row. And ironically, this is actually leading to more instability and more inflation and greater risks for our livelihoods in the medium to long term.
I think it's hard to know what the consequences of today's actions will be in the future.
Recession come 2023.
Are you calling it? Is it like I think a lot of people have been worried about whether this will happen or not. But like, the thing is, we didn't really get away from COVID unscathed. We just had a lot of problems financially, economically, and politically, kind of delayed in a sense. I think in the last year or so, we've had more wars and things like that, and they all like add together, unfortunately. And like, just the tool of interest rates, that's often good for inflation by itself, but for everything,
Well,
like it's going to be really difficult to navigate
clarify,
this time.
To actually clarify,
Yeah.
interest rate hikes are painful,
They are
extremely painful.
they kill the economy in a lot of ways,
Yeah.
or people's sort of discretionary spending, as well as businesses, and businesses are the ones that employ people in a lot of countries. So yeah, it will be tough, unfortunately, and I think there's already signs that things are starting to go a certain way. Some businesses, companies, particularly in places like areas like hospitality, and they're all struggling, and many are closing. So yeah, it's I guess interesting times ahead. And the other thing is in the area of housing and property. Everyone in New Zealand loves talking about it. I don't know about your workplace, but I don't know. What do you think might happen there? Like, we've seen some prices go up a lot during the low interest rates, but what's going to happen?
Well, there have been economists such as Charles Goodhart, Ken Rogoff, that have talked about how, for instance, like, how China and the U.S. economy have a lot of interconnection, right?
Yeah.
East Asian economies have pursued this export growth model.
Yeah.
So they export a lot of goods and services to the world, and at the same time, their population saves a lot of money.
Yeah.
And that saving pool gets invested into the United States and other Western liberal democracies.
Yeah.
So what happens is that they save a lot of money, and the Westerners spend a lot of money.
Yeah.
They get a lot of credit. They use that to buy property, buy this, buy that.
Yeah.
And my view is that actually this low interest rate environment that we saw from the 1990s to the late 2000s was partly caused by central bank mismanagement or poor monetary policy, but also due to demographic factors and globalization. Is that that's what led to the housing boom. What you see is actually a lot of that pool of money was actually invested in the property market at the time, and it was promoted by governments too. They were like, hey, here's credit. Use that credit because we care about your livelihoods and your families, and so you should just use that and get a home. And we'll support that. And there was a lot of government policies, of course. There was also globalization and U.S.-China relations that helped a lot. But now we're going in the opposite direction, where there's deglobalization, there's war, there's bottlenecks, there's building supply shortages, and you'll see all of this put a lot of negative effects on the housing market. And my view is that actually prices are gonna gradually go down. I'm not sure how far though.
That's a question, right? $1 million question.
But one thing that I'm definitely certain is that we will definitely see the cooling down of the housing market
all over the world.
I mean, the best way to describe this is the party's over.
Yeah.
The party's over, and you'll see asset markets continue to tumble. We saw the FTX actually, the cryptocurrency exchange company. It's sort of well known for being endorsed by Tom Brady and Larry David and all these celebrities. The crypto sector and the blockchain technology area is also seeing a lot of bubbles bursting.
Instability, volatility.
Yeah,
it's happening everywhere.
That's right.
Like things that people predicted would never happen, like housing market shrinking and house prices going down. That's been happening, and it might happen for a while yet. The cryptocurrency industry is unstable in itself, and we'll see more things coming. So I feel like everyone else just wants to know, like, should I still do, or should I start do, or should I just do? Should I do stonks or not? Should I be investing? Is it safer to buy, hold, or sell, or to just travel the world? I don't know. What is the...
Look, just to give one caveat, I am not a financial advisor.
I know. We'll say this is not proper financial advice, but what would you do? Like, I just like, what is a typical person at this stage of life, working a bit mid 20s plus or minus?
I think
Is it worth
no,
putting a bit in the long term
yes,
but also enjoying a bit of like
no,
I
not
think
like what I would do
the
is
season.
actually like just think about it, right?
Yeah.
Is like everybody has different choices. They
Yeah.
can do whatever they want with money. They can buy cocaine if they want, right?
No, we don't
it's
endorse
illegal.
that for sure.
I'm being sarcastic.
I know, no, I'm just just in case.
But as Warren Buffett says, save your money.
Yeah.
Don't overspend beyond your means.
I don't. Yeah.
Keep it simple. But invest in S&P 500s is something that he says a lot.
It's pretty safe. I mean, there's risk, but it usually tends to do pretty well. Like these market indices, I actually think these days it hasn't been the case in the last 5 or 10 years, but more fixed interest investments, they might be a bit more attractive these days. So your term deposits
depends on whether you're getting real returns or nominal returns.
I mean, I think with like a lot more volatility, I'd switch at least some of your portfolios into some of those investments, given like the changing market conditions. But not to say you shouldn't be saving and investing, but just I think I do think what the difference between a bear market and bull market is, right?
We're entering the bear market.
We're in the midst of the first year or two, I think, and these things tend to happen for a while. A bull market is when things generally go up in price.
Yeah.
Like bear market is things go down, but then sometimes they go up a bit. And
look,
then
it's
down
inevitable. Like Dylan, I'll say this. It's inevitable because I mean, if you look at economic history over the last 80 years, whenever unemployment went below 4%, and inflation levels went above 4%, there was always a recession. In the following 18 months.
Yeah. So that's kind of what's happened in the last while, and so we're about to see what the next 18 months will look like.
But all I can say is buckle up because things are not going to be pretty. And, there's geopolitical tensions. There is obviously an ongoing pandemic. There are fiscal challenges. There are, monetary policy challenges. And, the Fed are in a very difficult position. This is what I call a debt trap. Where governments are so indebted, where if you increase rates, you might see the risk of your government defaulting. That could crash the entire economy.
Well, yeah.
But if you don't increase the rates, you might not curb inflation.
And that could have really bad consequences.
And that can also have very bad consequences in the long term. So, my preferred option is actually to have moderate inflation of around 8.
It sounds crazy these days because we've been living in like a few percent in the last decade or whatever.
We're not gonna get back to that period of the prior 2019 economy where everything was at least in some sense stable.
With a higher rate of transient inflation, let's say 5%. I don't know, that's not the right terms, but like people getting used to things going up in price in general between 5 to 10% each year. I like to think of it this way. When you probably hear a lot about global warming, climate change, say when they warn that you don't want to have a global average temperature increase of 2 degrees over the Earth. That's a very simplistic term, but what that actually means in the climate sense is that some places go up by 5 to 10 degrees, some places go down by a little bit, and some go up by 1 degrees. In a inflation of 5 to 10% environment, more things will go up a lot, say fuel or things, and other things might not go. So there's more volatility in terms of prices.
Abstract. Yeah.
You know what I mean? When the average increases, a lot of other things move around that.
Yeah.
So essentially, in the next decade or so, I mean, no solid predictions. But although, there'll just be like a lot of things changing probably. Over the world, more of a bear market state, and you can't just sit back and relax, and not everything will completely take care of itself, and but it's still worth taking risks, calculated ones, at this time, depending on who you are and what you want in life. Yeah, and on that note, I'd just like to thank you so much for taking the calculated risk of listening to this podcast. Just to wrap it all up, I know that talking about economics isn't probably something that everyone does all the time while listening to podcasts like this, but hope that that was something interesting to add to your daily commute or daily lie around and listen to Chilling with Dylan podcasts. Period. So yeah, hope you learnt a lot and enjoyed this podcast. And thanks so much, Leo, for joining us. It's been fun and very, very informative again.
Well, thanks.
Yeah. You've listened to another episode of Chillin' with
Done.
Cheers.